You know owner contributions are important, but did you know there's a right way and a wrong way of doing them? And simple mistakes can lead to bookkeeping nightmares and even tax issues. So in this video, I'm going to go through a checklist of exactly what to do and what not to do while making owner contributions. First, let's see what exactly is an owner contribution. This is any cash or assets that you as a business owner have personally put into your business. And this can include cash. It can include assets such as any equipment, furniture, or tools you have contributed. And this is all with your personal funds, not business funds. And here's a tip. Owner's contribution even includes intangible assets and even services you've put in. So it can be patents or labor you've put into your business. But this can be complex. It needs to be valued by a professional. Another important aspect about owner contributions is that they are recorded as additions to your owner's equity in your balance sheet. Now let's dive into the do's and don'ts. The first one is that keep your personal and business finances separate. I know as sole proprietors or as single owner LLCs, most business owners tend to commingle their funds, but keeping a separate business account helps you to keep clean records. So whenever you make an owner contribution, say you transfer funds, you purchase something from your personal funds, it gets shown as a separate entry. So if you have a dedicated business account, then every time you make an owner contribution, there is an actual record of doing so. This keeps your bookkeeping clean and it's great for tax purposes as well. The next one is to record your contributions properly. Don't record them as income. They are not income or a revenue for your business. They go into your balance sheet as an addition to your owner's equity. And I'm going to show you how I do it in my business bookkeeping spreadsheet. I'm now in the dashboard of my Mega Business Bundle. Over here, you get to see an overview of how your business is performing on an annual as well as a monthly basis. You get to see your total income, expenses, profit, and profit percentage. You also get a breakdown by your income sources as well as your expenses. If we go further down, you have capital expenses, and then you come to your non-operating items, which includes owner draws and owner contributions and the net equity. We also have non-operating income and non-operating expenses. To record owner contributions, we would go into the non-operating items tab over here, enter the date, choose the category as owner contributions, and let's say we contributed $1,000. Now if we go to the dashboard, you'll see in August, under owner contributions, there's $1,000. And if we go all the way to the right, you'll see the total is $1,700. The owner draws were $500 and the net is $1,200. We will now go into the balance sheet and add the net of $1,200 to our owner's investment. And this becomes your total equity. The third important point is to keep detailed records of contributions, especially if it's a large contribution like equipment or property or vehicles. Keep all your receipts, agreements, or even maintain a memo on file, because these are very important to show that you have valued these assets correctly in your balance sheet. The fourth important point is to use owner contributions strategically. Use them as startup capital, or use it when you need bridge funds in order to, say, pay your salaries and wages to your employees, or you need capital for inventory. Or say you want to have your balance sheet looking good, so banks and investors know that you have some skin in the game. That's when you make owner contributions. The fifth important point is to track your contributions against your owner draw, because this shows how much you've invested and how much you've withdrawn, and the net of these amounts is added to the equity in the balance sheet. Now we come to what you should not do with owner contributions. The first important one is never record them as income or revenue, because if you do so, you're going to inflate your profits and unnecessarily pay taxes. The next point is, don't mix owner contributions with loans. Owner contributions should be kept separate, loans should be kept separate. If you've lent money to your business, that's a loan and should not be taken as part of your owner's equity. Third point is, don't forget about non-cash distributions. For example, if you've contributed a laptop you already own, you should record the fair market value of that laptop on your balance sheet. Now, this next point is very important. Don't rely on your memory. We tend to think, okay, I'm going to remember this for later on. Say you walk into a Target and you pick up some clothes and then you remember, oh, I've got to pick up an ink cartridge. And you put that on your own personal credit card and next thing you know, you've forgotten about it. So keep proper records because even these small purchases do add up to your owner's contribution. Now we come to the last and most important. Don't make owner contributions without a plan. You should not be using owner contributions excessively because that means that your business has a chronic shortage of cash and you would need to change your business model. Use it strategically, like as I said before, when you need a business loan to show to investors and banks that you have a healthy balance sheet with a lot of owner's equity in it. Talking about business loans, maybe you're a new business or your business is growing and you need funds to grow. So you should probably be looking at banks or investors. I have been a business lender. I used to work at a small community bank and large commercial banks, and I was responsible for approving loans up to $1 million. So I've been on the other side of the table. And I know exactly what banks look at when they approve loans to small business owners. And so I put together this course, which basically handholds you through the whole loan approval process. And I start right from the basics, including how to set up your business, how to present it, to maximize your chances at getting finances. I go over all the documentation you need. But in addition to documentation, there's a lot of human elements involved too. And I have some insider secrets, which I include in my course. And I'm also including my entire mega business bundle in this course. And this will help you to get all of your documentation ready. You have your profit and loss statement, your balance sheet, your debt schedule, your cash flow statement. You have your accounts receivables and payables aging reports. You even have your inventory valuation. I've even included a business plan. So I'm going to be leaving a link to the business course in the description below. And if you would like to see how the Mega Business Bundle works, check out this next video.